The easier a deal is to buy, it often means it is harder to sell on the back end. The deal that you're looking at that there's no competition for, it's off market or nobody else really wants it, is that way typically for a reason, and you will find out what that reason is once you own the property, and even worse when you go to sell the property. You see, the deals that we have bought with the least amount of competition, where we thought we were the only buyer, we thought that was going to be a great deal, we were super excited about the opportunity, but in reality we were buying a headache because we were actually taking on a risk that everyone else in the market wasn't willing to take, at least at that price. And that's the reason why it's so difficult to actually find something that's truly undervalued and underappreciated. Because the market is so competitive and efficient, you're typically actually better off buying a property in a competitive bidding situation. And I know that's counter to the narratives of off market and, oh, we're direct to seller and there was no competition on this deal, but that's just the reality of the market. If you're competing against 20 other bidders to buy a prize trophy asset, that speaks to the low risk of the deal. It doesn't mean it's going to be a home run, and it could still end up being a bad deal, but it is showing you that there is liquidity for that deal. And liquidity buttresses prices, because that liquidity on the buy side is likely also going to be there for you on the sell side. So when you go to sell 3, 5, 10 years down the road, you will also enjoy the benefit of 20 plus bidders, just as you struggled against that competition field on the way in. And an increased buyer pool, more liquidity, increases your price when you go to sell. That's what allows cap rates to compress. There's a similar philosophy regarding equity, and that is the deals that are the easiest to raise equity for are not necessarily the deals that are the best. It's just the deals that the market, investors, are the most optimistic about. But it also speaks to liquidity in a similar way, in that it's liquidity coming in via investor interest that's actually driving up prices and driving down expected returns. So this is where being opportunistic, if it works out greatly in your favor, because you did something that was contrarian, so it was non-consensus, and if it works out, you are getting paid disproportionately based on that contrarian bet. Whereas if you invest in something that is super easy to raise equity for, all investors are in agreement that it's a great opportunity, the outsized return possibility is usually priced out of that opportunity. So when the deal does go well, you're actually just going to get a okay, mediocre outcome. Definitely not amazing, but certainly not bad. So equity liquidity, or liquidity from an investor standpoint, what it does is it narrows your scope of outcomes, generally speaking. It means that you're less likely to do horribly, but you're also less likely to do amazingly. And that's actually a strategy that works perfectly fine for us. We're fine buying deals that are on the safer side in terms of there being a lot of buyer competition on the way in, and also investing in strategies that are more consensus than not. Even though that is reducing or putting a cap on our upside, we'd rather cap our upside and also cap our downside than have totally unlimited exposure in both directions. So what this means for our acquisition strategy is we're looking for institutional quality location and property type in our multifamily sector in Texas. And we're also looking for lower leverage and longer term holds. Actually expands your universe of buyers, increasing your exit liquidity, which allows you to be an opportunistic seller to exit at the best valuations. At the same time, when you couple high quality real estate in a growing location and lower leverage coupled with full term interest only payments, all these things allow you to maximize cash flow during your hold period. So you're actually not dreading and waiting to finally exit the property. Rather, you're enjoying every single month of strong cash flow through the deal. And because it's a high quality asset, you're not waiting for a shoe to drop where there's a boiler or a chiller or a roof or a plumbing problem that's just waiting to wipe out your whole year's worth of cash flow. Good location and good quality real estate actually goes up in value. And people think all real estate goes up in value, but this is the real estate that actually does the job for you, rather than you feeling like you're putting in the work every single day just to secure another lease, just to battle turnover, just to fight against your deferred maintenance and your depreciating physical structure. So remember, if it's easy on the way in, it's actually a trap. It's going to be hard on the way out. So it's kind of like delayed gratification. You want it to be hard on the way in because that's going to make the rest of the deal easier as you go.